Hello class, my name is Samuel Dykes and today I will be covering Chapter 6, pages 13 through 23, primarily focusing on the different types of itemized deductions that taxpayers can utilize. So what we will cover, the various types of interest expense deductions, home ownership interest deduction, investments, charitable contributions, contributions of money, contributions of other property, not relating to money, and then gambling expenses. The first one that we'll talk about is interest expense. There's two types of interest expense deductions. There's the mortgage interest deduction, which focuses on homeowners for personal use. And there's investment interest deductions focusing primarily on bonds, stocks, and other investment vehicles. Home mortgages are typically reported on the 1040 tax return. Mortgage interest can be paid on personal properties or rental properties and is also deductible but is reported on Schedule E. Investment income is reported through ordinary income. So home ownership interest deduction, mortgage interest is limited. Limited deduction is up to $750,000 or the acquisition price of the home. So the government tries to do this primarily to incentivize homeownership. However, decides to cap it at $750,000, realizing that individuals who have the wherewithal to purchase a home that's over $750,000, they do not need the benefit of the extra interest deduction from their home mortgage. And interest paid on up to $100,000 of a home equity debt is also deductible. The types of loans that allow you to deduct interest include a mortgage to buy your house, a second mortgage, so vacation property or rental property, a line of credit, so a home equity line of credit. With that, a good example of this would be Courtney acquired her home in Kansas City in January of this year for $300,000. She purchased it by paying cash and $260,000 for a mortgage. Courtney paid $14,848 interest on the loan. How much is this interest? Courtney can deduct. She's allowed to deduct up to the full amount of interest that she paid for the year off of her adjusted gross income. So that would be $14,848. Another type of deduction is related to investments. So as I said before, this primarily relates to stocks, bonds, and land. Deduction on investment interest is limited to the subject's investment income, so you cannot deduct more than you've actually made on your investments. Interest in excess of net investment income, however, can be carried over to the following year as a deduction for that period. Another type of deduction would be related to charitable contributions. Political and campaign contributions, however, are not deductible. So an example of this would be you donated to either President Donald Trump or one of the Democratic nominees or one of their various super PACs for political ads. This cannot be deducted from your tax returns. However, the government does allow you to deduct from certain types of charities that are recognized. Taxpayers can deduct their contribution up to the market value of the capital gain property on the date of the donation, and can also deduct the money that they received from or donated to the organization up to its fair value. An example would be a church or a school that would qualify for this. There are some limitations to this, however. Deductions are limited up to 60% of adjusted gross income for private charities and 50% for public charities. So a private charity would be a school of some sort, and a public would be a non-for-profit that's related to a government entity. Deductions for capital gain property donated to charity is also limited to 30% for public and private charities related to capital gains. And cash deductions are limited at 30% for private non-operating foundations and 20% capital gain property. A private non-operating entity would include an organization that is not directly a charity but um, donates its belongings or assists with a charity. A couple of examples of this. Courtney donated $1,700 to the American Red Cross. Can she deduct the full amount? The answer to this is yes. The American Red Cross is a recognized private charity. Courtney donated $200 this year in cash to homeless people while walking past them on the street. Can she deduct this amount? No, she can't deduct this at all. That is not a recognized charity. It is just a good act and a good Samaritan performing it. Contributions of money. Cash contributions are deductible in the year they are paid only. Travel and transportation costs are considered contributions of money if the travel is for charity. So if you're driving from your house straight to a charity, you can deduct that amount. But one thing to keep in mind is if you're traveling and you make stops in between, you cannot deduct that. You can only deduct the direct route. And this deduction is the equivalent of 14 cents per mile. It is important to note, though, the taxpayer cannot deduct the cost of the service they are providing. So if you would typically charge, say, $200 to perform someone's tax return, but you're doing it for a charity, you cannot deduct that from your adjusted gross income. Some examples: Courtney does volunteer work at Goodwill Industries and traveled a total of 500 miles and provided services worth $1,500. How much can she deduct? Well, the answer would be $70, and that is reached by taking the 14 cents times the 500 miles she traveled. And as I previously said, she could not deduct the $1,500 of the value of the service that she provided. Contributions of property other than money. Amount a taxpayer can deduct depends on if the property is capital gain property or ordinary income property. A taxpayer can deduct the fair market value of capital gain property. Capital gain property includes investment assets such as business assets or personal use assets. Taxpayers contributing to ordinary income property can deduct only the lesser of the property's fair market value or the property is adjusted on an adjusted basis. Some examples of this would include Courtney donated 100 shares of stock to her church, which is a qualified charity. Courtney purchased the stock for $2,600, but the shares are worth $10,600. At the time of the donation, how much can she deduct? The answer would be the $10,600, being that this is the fair market value currently of the stocks that she donated to the charity. Courtney estimated that she paid over $900 for donations to Goodwill. Items include a table and a couch. The items are worth $160. How much can she deduct? This is the same concept here. You're deducting the fair market value of the items currently, which would be $160, not the amount that she paid, which was $900. And some other miscellaneous expenses or things that you can deduct off of your adjusted gross income. One of them would be gambling expenses. Gambling expenses are from gambling losses and can be deducted to the extent of the gambling winnings for a given year. Gambling winnings are taxed at 25% rate if the winnings are in excess of $5,000 or 300 times the amount wagered. So typically with gambling, the government tries to disincentivize it. So it would be an example of a sin tax where the gambler is engaging in a behavior that the government does not want to incentivize. So taxes on these types of winnings are subject to higher rates for the sole fact that the government is trying to disincentivize people from partaking in those. Versus with a charity, they are looking to incentivize people to actually donate to charities and for the better of society versus them seeing gambling as a taboo. Um, in conclusion, by allowing certain deductions from taxable income, the U.S. government is seeking to incentivize certain types of behavior. Governments allow for deductions of charity because they benefit society as a whole, and for mortgages because the government sees still the owning a home as the American dream and wants people to partake in that and have that opportunity in their life. The U.S. government also looks to tax gambling income more to discourage from society that form of behavior. Um, and by implementing certain taxes and by allowing for certain deductions, governments can influence behavior without needed to directly implement a law. So, by, for example, um, implementing a sin tax on something like gambling, um, the government is essentially saying that they do not want people to partake in this activity versus them actually putting into law this is against the law. It's just another way that they can sway people's behavior without actually having to write a law. Um, and finally, the sources I used our textbook Taxation of Individuals. I looked at TurboTax's website and what they had to talk about for the mortgage interest deduction. And I also looked at thebalance.com relating to gambling and how the federal government taxes gambling income. Thank you for watching the presentation, and I look forward to meeting each and every single one of you and hearing what your thoughts are and listening to all your presentations as well. Thank you.